All the participating lines right now, and then I'll get right back to you and we'll move forward with our presentation.
All guests have been muted.
Okay, once again, I just muted all the lines. So if anyone has any questions, you can email me through the system. But again, thanks for everyone for our product launch now and our term enhancements. So let's move forward here. Our term enhancements. Now, we rolled this out on Monday, May 19th. Basically, like I said earlier, there's two parts to this term enhancements. We have a term optimization, which we went back and looked at a lot of the cells, and we looked at our mortality and were able to make some changes there. And then also the benefit distribution agreement. And that is basically our rider that's going to help you lower your cost of your premium or raise your total death benefit based on extending the payouts of the death benefit over time. And I've got a lot of examples on that we'll go through. So let's talk real quick about our sweet spots right now on our term products. Now, this is prior to us making any changes with our term optimization, but I like to just kind of talk about Minnesota Life in general on our term. 20-year duration is really a sweet spot. Now, we didn't make any changes to this one right now because we're very strong in this area, so there wasn't any changes needed. 30-year duration, that is another sweet spot with Minnesota Life. We're one of the few carriers out there right now that still offer this duration. Band 2, now this is where you're going to see basically the changes, a lot of the changes that we made. Now, Band 2 for Minnesota Life is $250,000 to $1 million. And that's where we did a lot of the term optimization. And then also Band 1. This is a sweet spot for Minnesota Life, basically low end. Now, we have lowered our express issue down to $50,000, so we're going to be playing in that market now. And then again, I put high end there because of the 30-year duration. So we've got some sweet spots here with the Minnesota Life term products. In the past, you'll notice that, we got a lot of business based on a couple of things, basically Minnesota Life and then our term conversion opportunities. We allow everyone to convert to any permanent product that they're currently allowed to sell, plus we have our 5-year basically conversion credit that we offer, so we can get more into that in a little bit. But these are kind of the sweet spots that we have right now. So let's talk now about the 4 main points of the term optimization and kind of what we did across the board to really make an impact on what you're seeing here. The first thing, and I'll go into detail on each one of these in a separate slide, but the first off, we lowered the express issue minimum on 10 and 20-year plans. Basically, we lowered that down to $50,000 for you on express issues. So we got a lot of calls on that, a lot of people looking for lower faces. We currently were at, prior to the 19th, at $100,000, so this is going to help bring in some of those cases that we had to turn away in the past. So we're definitely lowering that down to $50,000. The second thing that really helped out with our term optimization is we changed the policy fee on Band 2. Now, again, Band 2 is $250,000 to $1 million, and that's on 5- and 10-year plans. Now, the policy fee change, I'm going to show you on another slide coming up, but it's basically a little different that's in the industry right now. It's going to be based on a sliding scale. In the past, we had a standard charge across the board for Band 2 term at $95. Now we're going to give clients the opportunity to go anywhere from $70 to $95 based on their face. So that was one way to really lower our costs and make us more competitive in that field. Third thing that we'll get into is a maximum face limit on 5- and 10-year plans. We don't have too many of these on the books, but we did set the face at $5 million for 5- and 10-year plans. And then the last thing, and this is kind of the main point that we've been talking about and where you're going to see the most change with lower premiums, is the rate changes on Band 2, which again, $250,000 to $1 million on 5- and 10-year plans. Now, I'd mentioned earlier that, we really got a lot of term products, and we did a lot of sales based on, our mutuality, our conversion privileges, and our conversion credits. And now, when you take into account, and like I said, I've got some illustrations coming up here, I would say we were kind of middle of the road when it came to premiums against our top 10 competitors, and we were winning a lot of those cases based on those three things. With this new change that you're seeing, with us going through and taking a look at these cells and lowering these costs, we're definitely in the top third now. Plus, we still offer the mutuality, the conversion, and the conversion credit opportunities. So these are the four main points. Now, what I want to do, let me see here, move the slide ahead. What I want to do is jump into each of these points individually. First off, just want to show our approval map right now as of 5/12. We are currently, for the term optimization, approved in 48 states. We have it pending, obviously, in Montana and New York. Hopefully those will be coming shortly, but as of right now, 48 out of the 50 states are going to be able to take advantage of our term optimization that we've done across the board with our term products. Now let's go into each one of those individually now. The first point that we talked about earlier was the lowering of the express issue from $100,000 down to $50,000 on 10 and 20-year plans. So this is a great play for us, especially in a great competitive play. There are a few companies out there that are under $100,000 with their express issue. One of them that comes to mind that I know I used to get calls a lot about was Nationwide. Now they go down to $25,000. We weren't willing to go that low, but we did set ours at $50,000 for the express issue. A couple of things to point out here is that if you have a $50,000 term policy, or you're under $100,000, and at some point down the road you'd like to take advantage of the conversions and convert that to a permanent policy, if you are under $100,000, you'll have to convert the full amount. And then the second one, basically, and this is pretty standard for what we've done currently, is that all partial conversions, $100,000 must remain in the term policy. So basically, let's just say you have a $200,000 term product, and you turn around and you want to convert 100 of that, you have to remain 100 in the policy. If you do more than that, you'll just have to cancel that term policy for what's remaining. So that's kind of the first main point here, is the dropping of the express issue band down to $50,000. Now this is the second point that we talked a little bit about. Now I mentioned that policy fee change, and again, it's unique and it's not seen in a lot of companies, but it's a sliding policy fee for band 2 on 5 and 10-year plans, again being $250,000 to $1 million. You'll notice there that the policy fee will range anywhere from $70 to $95. Now, prior to this, across the board, it was $95. So this is a way that we were able to cut our costs within our cells for our term products by getting our costs down. Now, we only did this in band 2 because this is where we see the majority of our sales, and we want to avoid this cost adjustment across all the bands. So that's going to be a little different. I'm sure you're going to get some questions on that. Here is kind of a policy fee chart, so you can see kind of how it looks. Now you'll notice here this isn't exact. Well, it's exact to these faces, I should say. We obviously didn't want to put every dollar amount here, so this is every $50,000 within band 2. And again, we're going to round down to the nearest dollar. But basically, let's say it's between $350 and $400, maybe $375. That would probably fall into the $74. It doesn't fall into exactly one of these. These are just examples of every $50,000 for you. So let's talk about points 3 and 4 right now. Basically, that maximum face. And again, we did a lot of these things to help cut costs overall. But what we did here is on the 5 and 10 year, we put a maximum face of $5 million on this. Now, we don't, like I said, we don't have a lot of these on the books. Now, it's my understanding, and this is kind of why we did this, is it's a reinsurance issue. There's a cost issue at a lot of higher face amounts. So Minnesota Life is now retaining all these cases on Minnesota Life paper. So this is one way for us to keep our costs down by not having any 5 and 10 year plans over $5 million, because we don't have to turn around and pay the higher cost of reinsurance. So that is something that you're going to see. Now, the final one, and kind of the most important one, I think, is the rate changes. Now, this is going to be, again, on Band 2 for 5- and 10-year plans, $250,000 to $1 million. And I can't say it, totally overall, but when we start to get into the charts or when you start to look at some of the pricing out there, you will see that the majority of people under the age of 65 are going to see a decrease in the premium cells that they would have been paying. Now, we think this is a great play for Minnesota Life because before I mentioned we were probably middle of the pack when it came to premium, and now with these rate changes, we've definitely moved into the top third. And later on, when we go through this new rider, the Benefit Distribution Agreement rider, we can definitely be one of the lowest premiums out there. So let's talk about how this came about with these rate changes. Basically, this came about because our actuaries were able to go back and they were able to identify on 5- and 10-year plans that our early mortality had been better than expected. So basically, every 5 to 6 years, our actuaries will go back and they will check our cells, they'll review our mortality and see how we're doing. And it just kind of worked out with all the other changes that we were making that we were able to notice that we had better than expected mortality to make these changes. And like I said, basically you're going to see a decrease in the premiums across the board, not 100%, but pretty much for clients 65 and under. So let's move forward and kind of take a look at that, how the landscape looks now as far as the rate changes on Band 2 for 5- and 10-year plans. Now, this is kind of a before and after shot against against 10 of our competition that we see quite a bit of. The left-hand side being basically where we ranked 1 through 10 based on male, female, the age, and then the underwriting class that they got. And then you notice on the other side, the new competitive rates. Now take a look at where we are. You're going to see a lot of 1s, 2s, and 3s, and a lot of decrease in the premium on those cells. And again, I can't 100% across the board, but mainly under age 65, you're going to see quite an increase. There's a couple of them here that I want to point out that I think there are a couple of cases that we see quite a bit. You take a look here at a female, age 55, preferred select, $250,000 face, 10-year plan. Well, prior to this change, and this is based off the original, the prior piece that I just shown, out of 10, we were number 4 against the people we come up against the most. Now we are 1-2, tied with Banner PO term on that. So we went from the 4th spot to the 1st spot in a female 55 best class, 250 face. Another one that I saw quite a significant change was on the male side, age 30, standard non-tobacco, $250,000 face, 10-year plan. Now, again, here we're in the same premium of 178, number 1 with Pac Life. Prior to that change, we would have been 6th on this list out of 10 for our premium. So those are a couple of examples where we've seen a huge shift in going back, reviewing our mortality like we do every 5 to 6 years, and then taking that data and being able to offer lower premiums to our clients. So that's kind of what's going on with the term optimization portion of this, of basically what we rolled out on May 19th. Lower express issue down to $50,000. We were able to lower our policy fees based on that sliding scale. We capped a couple of our maximum face limits on 5- and 10-year plans. And then the main one is we had rate changes across the board for Band 2 on 5- and 10-year plans. And the whole while we still maintain the same type of, items that basically won us business in the past as far as our mutuality, our conversion opportunities, and our conversion credit. So now I want to move forward to the second part of the presentation, and this is the rider that we have now added to term. Now, this is called the Benefit Distribution Agreement. And basically what this is, kind of a high-level, definition of this is an agreement that allows the client the right to direct all or part of the policy's death benefits to be paid in installments. Now, again, we'll go through some examples, and there's a lot of info here, and I'll give those phone numbers out again at the end of the call, where you can call your sales and support line, or you can call your career wholesaling desk, and they can walk you through some examples. We've really built the illustration system to lay it out with and without this rider, so the client can really see the significance of adding this rider on there. But again, it's something that you add onto a term policy. You dictate upon your death how the death benefit is going to be paid out, and because we know we're going to have that death benefit over a certain amount of time and we're going to pay it to your heirs, we're going to give you hopefully either a significant savings on the front end, or we're going to be able to offer you more of a benefit at the same premium. And like I said, we'll get into a couple examples here. Now, I kind of just said that here as far as what this rider can do. Two things that can happen when we add the benefit distribution agreement again. We can get a lower premium, or we have an opportunity for an increased total benefit amount. So, again, here's the quick map of the benefit distribution agreement. We are approved in 49 states. Again, New York is one that is pending, and as soon as that gets approved, there will be a communication to the field where you can move ahead and add this rider to our term products. Here are the two examples I'd like to go through. Now, I mentioned earlier that there's two ways that this rider can really help your clients, one of them being a lower premium payment. So let's kind of just walk through this example. The top part is going to be a client, male, age 40, preferred non-tobacco, looking for a 20-year term. Okay, so they walk into your office and they have a need of $1 million worth of coverage. Now, simple term policy, like I said, 20 years, lump sum, the way we sell them today, that annual premium is going to be $965. Now, if the client were to elect this new rider, this benefit distribution agreement, and designate that 100% of the death benefit be paid out in annual installments over 30 years, we're going to be able to save the client almost up to 34% annual in savings. Now, you'll notice there the death benefit is $1 million. The face amount is $600, but they came in needing $1 million worth of coverage. So as long as they accept the $33,000, or they accept that this is paid to their heirs, the $33,000 and change annually over 30 years, we're able to get that premium down to $629. So that's one way that this rider can help out, by decreasing the premium amount for your clients. If there's a certain need for an amount of coverage to protect themselves, maybe they're a younger age, they have a fixed income, they need to protect themselves from a home, cars, put people through children through college, and they have a tight budget, we can help them this way. The other way that this rider can really benefit them is not only in the first situation lowering the premium, now we're able to increase the total benefit amount. So we know earlier in our example earlier that $965 was going to buy $1 million lump sum. So let's just assume that that client is comfortable and comes to you and has a set premium that they'd like to pay. They say, I've got a $965 budget. Well, I know that's going to pay $1 million worth of face, or that's going to, what the coverage is going to be. Now, let's assume again that I elect the BDA. I designate 100% of that benefit to be paid out in annual installments over 30 years. You'll notice there that the annual installment benefits now are $55,000 and change over 30 years, and it increased my total benefit amount to almost $1.7 million. So an increase of $666,667. So there's two ways, again, we can go about this. We can lower the premium, or we can take that same premium and we can increase the total benefit package. Now, on both of these situations, I chose 100% over 30 years. The client is going to have other options as far as what they want to choose. As you know, they can designate certain percentages, and they can also designate different periods of the payments going out. And we'll go through that here in a couple of the highlights. So, now, a couple of things that we need to know about this when we're adding the benefit distribution agreement on is that this is exclusively available on Quick App. Now we have, like I said at the end of my presentation, we have Jeannie Jorgensen from Life New Business and we have Katie Clark from Underwriting who are going to go through and show some examples. Did I say that right? Call center, I'm sorry. She used to be an underwriter, my fault. That are going to come on the end of this, and they're going to go through an example on our support and how we're going to show this through the e-app system. Because, again, we want to make it very clear to the clients that there's a few things they have to know about when they add this rider. And like I said, we set the illustration up to be very clear. So, again, exclusively available on Quick e-app. And I'm going to give my Quick e-app commercial now because this may come up a little bit, but we're really pushing the Quick e-app. We think it's a great tool for our clients. We just think it's a better client experience, and there is a cost savings that we're able to pass along within our products. A couple of stats that I always promote when we're dealing with Quick e-app is that it's my understanding, and I've checked these before, that our not in good order ratio is at about 90% for our applications that come in on paper. Well, obviously, when we're using Quick e-app, 100% of that's going to be in good order. So that's really going to help us cut down on our not in good order. It's going to make it a lot cleaner for the reps, not having to go back and forth and provide information. The other thing, too, is when you use Quick e-app is that approval time is 20 days faster currently. And that's 20 business days, so that's basically a month for the client to get coverage enforced quicker. And, you know, the final thing is when coverage gets enforced 20 to 30 days earlier, the rep, the advisor, is getting paid 20 to 30 days earlier. So that's my Quick e-app commercial that I always like to share. So a couple more highlights. $100,000 minimum when you add the BDA onto a term policy. There's no additional cost, and you can only add this at issue. Now, the schedule of payments is determined at issue, and it can't be altered, and that was earlier when I showed you that when they chose 100% over 30 years, we knew that in one situation it was $33,000 and change over 30 years, and the other situation we knew it was $55,000 and change over 30 years. So that's all going to be set at issue, and you'll be able to share that information with the client so they know what will be paid out upon their death. Can be removed from in-force policies. Now, not a problem. If they get down a situation where they want to remove this, that's not a problem. There's a few things that I'll share with you about when you remove it. And that kind of sticks to the last point there, that conversions allowed at face value of policy. I kind of want to go back to this example right here where we showed the lower premium amount. And this is important to know that conversions are allowed at face value of policy. This is a situation where we had $1 million. We knew the annual premium was $965. Well, we were able to cut that premium again, 34% down to $629. But we have to remember that everything is based on the face amount. So this client has $1 million worth of coverage, and that's the amount that will be paid out upon their death. But there is a face amount that's lower. So if they were to convert or do a conversion, they would convert over the face amount of $600,000. So that's one thing that you're going to have to be aware of, is that when you're building these things, if you have every anticipation of doing a conversion at some point within these two durations, just be aware that it's the face amount that will be transferred over. A couple of more highlights that I want to talk about is, I mentioned earlier in my two examples that I did 100% over 30 years. Well, you have 4 installment options, 25, 50, 75, and 100, available monthly or annually. And then we have 3 periods, 10, 20, or 30. Now, obviously, if I choose 100% over 30 years, that is going to give me my biggest break on my premium. But you do have other options. We do have a lot of clients who are taking a look at the 50-50 option because they're younger and they know that if they were to pass, they would like a large sum paid to basically their heirs, maybe a family member, to help pay for current costs. And then basically they know there'll be an income stream for another 10, 20, or 30 years that will be paid to their possibly a spouse. A couple of other things, if the beneficiary dies, because when they name a beneficiary and something were to happen to the owner, the beneficiary will then name a beneficiary, and if they're not on file, that will go to the estate of the deceased. All installment payments will be equal. We showed you that earlier with the 33 and the 55 examples. And then basically the remainder of lump sum portion is paid accordingly to the policy's requirements. And that's a situation where if you choose a different installment period of 25, 50, 75, or 100. A couple other things that aren't on here that I know I get quite a bit of questions on is that, again, conversion credits will work the same way as they work today. There is no change to the compensation design. It's based on premium amount as it is today. You can do face decreases the same as today because, remember, it's all based off the face and not the total benefit amount. So everything's going to work the same way on that. So those are a couple of things that I just wanted to add. One other thing real quick, too, is a very popular rider that we have is the Accelerated Benefit Agreement, which is the terminal illness rider. Now, if you choose 100% of installment payments to be paid out at death, you can't add the ABA because you can't take a withdrawal or accelerate your death benefit if you have terminal illness because you've already dictated that 100% of that's going to be paid out upon your death. So if you choose anything less than 100, 75, 50, or 25, then you can add the Accelerated Benefit Agreement for that portion. So that's one thing that you might see when you're going through the illustration system and try to add that rider at 100%. The system will stop you and tell you that you can't. If you drop it down to 75, 50, or 25, you'll be allowed to add that. Now, this is one thing that I just kind of want to talk a little bit about where I've seen some significant changes and some places that we can really help with this rider, this benefit distribution agreement, is on the term-perm combo. If anyone's looked at our software before, we have a real nice presentation deck on our term-perm combo, basically combining term and permanent coverage. I always use myself as an example sometimes. I am married, small child, and I needed, when I got my life insurance, or when I went in to see how much life insurance I needed, they dictated I needed about $1 million worth of coverage. Well, at the time, $1 million worth of permanent coverage, and I'm basing everything here on the target premium, would have been quite expensive for me. In fact, if we look at it at my age when I opened that up was 35, preferred select, $1 million, the target premium was over $10,000 for me to maintain permanent coverage. Now, what I did on the term-perm combo was I had to lower that. So I went ahead and I bought $250,000 worth of permanent coverage, brought my target down to $2,600. Then I added a term product for $750, which basically was $433. So I was able to get my cost down under $3,000 and still have that $1 million worth of coverage. Well, now, if I would have added this benefit distribution agreement, I would have been able to lower that term portion from $433 to under $280. So even cutting costs even more. And that doesn't seem like a lot right now, but that can have a huge impact on some of the younger people that we're talking to that really have a budget that they need to stick to. So that's just one thing I always like to share with my example is that I do this term-perm combo, and now I'm starting to offer this to clients with the BDA. So here's my one example of someone that I recently talked to where I was able to take advantage of the benefit distribution agreement. Again, pretty similar situation. I won't get into it too detailed, but we have a client, 35, married with 2 kids, current needs, future needs, okay? Obviously, the premiums would be quite high if we went ahead and got $1 million worth of permanent coverage. I can tell you right now, at this situation, similar to the one that I was in, $1 million of permanent coverage at target premium would run this client, Fred, about $11,000 a year. That can be pretty steep. Well, if you took a look at and did a $250,000 permanent product again, you're looking at about $2,600. And then if you do $750,000 term, it's $936. Now, I added on a 30-year BDA, 100% of it, and I was able to drop that premium on the term down to under $600. So I was able to take $1 million need at permanent coverage that would have been $11,000 annually and drop it down to about $3,000 for this client. Still has that $1 million now, and the great conversion privileges that we offer here, Fred and myself is able to convert that $750,000 of term over the next few years into his permanent, as hopefully, his income goes up, maybe his expenses go down. So that's one thing that I really want to share, where this rider is.
I like Genworth, and we sell our Genworth. I like Minnesota Life, and Minnesota Life is a good product, as far as products go. But when we look at long-term care, my mother was 73 when she passed away, and we had bought a 15-year long-term care policy on her life. She went to the hospital one day, she died the next day. So those $1,800 of premiums for 15 years, what happened to it? It's gone away. Okay, but she was a good steward of her money because she knew that if something happened to her, she didn't want to be a burden on her family. And see, one of the things that I tell people how you can tell if you need long-term care insurance. The next time you look at your mother or your father, ask yourself quietly, don't ask it in front of them, could I spend the night with them and change their diaper and look after them and take them to the bathroom and do all that stuff? There's nothing negative about that. You just have to ask yourself, are you capable of doing that? If you're a strong person, you could probably do that, and you'd be all right. When my grandmother died at 99 last December, my aunt has looked after her for the last, 10, 15 years. My mother did it until she died. Well, see, now with these new products, don't think that they're long-term care products, because they're not. In North Carolina, we have to have a special license to sell long-term care. With Minnesota Life, with the product that they have, this product allows you to have a death benefit, to have a cash benefit, have a retirement benefit, have a guarantee, and have a long-term care-like benefit for critical illness. And as long as you have 2 of the ADLs, the assisted daily living, you can actually get 2% of the death benefit per month up to $1 million. So a good example, if I went out today and I bought a $1 million life insurance policy and I had to go into a nursing home, 2% of $1 million is what? $2,000? So I could receive $2,000 a month for how many months? A long time. Now on that rider, you also have the benefit of getting 4%. So if I purchased a $500,000 policy, I could get 4%. And so 4% would have still gave me $2,000. Now, a benefit. Now, when we look at these products that are out there, we've got the standalone product, and then what I call it is the hybrid product. Because the hybrid product will actually allow you to go out and buy a life insurance product that builds cash value, that has a long-term care-like benefit. It's not a long-term care policy. But when you do that and you see how that policy actually works, now here's what happens. If you die, your family gets a death benefit. If you live, you can pull out part of the cash. If you retire, you can pull out the retirement benefit. If you go into a long-term care facility, you actually can pull out some of those benefits. We also have an accelerated death benefit for someone that had a critical illness that you had less than 2 years to live. So they call that an accelerated death benefit. Anybody got an idea how much it would pay? 75%. And what would be the maximum that you could pull out of that policy? Up to $250,000. Okay, now, Mark had that happen to one of his clients. The wife called, the husband had a terminal illness. They were worried about what they were going to do. He reminded them of that benefit, and what happened?
He pulled money from his policy and got his affairs in order, and when he passed away,
They gave her the net balance. And see, so now these policies only been around since 2009, 2010. So when you talk to people about their review and you talk to them about their insurance, one of the things that I always tell people, you know, everybody understands about premature death. Everybody understands that they have an unsure future. The third thing that I always talk to people about is that how have you taken care of disability? Both short term, if something was to happen to me, and long term, if I'm confined to some type of facility. And see, one of my good friends that is our chief marketing person for the United States, her name is Sheila Ruiz. Her mother died last night at 1:30. She had been in a nursing care facility for over 10 years with Alzheimer's. And if you look at statistics, that's one of the longest things that you could stay in a nursing home for. It ain't normal like, you know, we've seen people go get cancer and had a stroke and stuff like that, had a heart attack. Most time, 4 years is a good enough benefit. So when we look at it from a lifetime standpoint, when we look at the Minnesota Life product, we're in control of it, but we don't really know how those products actually work and whether we even qualify for those. And see, until a person actually realizes it, they never even know that that's an option for them. And so when we look at the fact finder that we got here, this is a pretty neat little piece, and I've put that in the kit for you. And I even have done it with a handout. And so that handout, did I give you one of these handouts?
Yes.
When you look at the handout, it's got a little teeny piece there that starts talking about, and we don't have enough time to spend all day, you know, going through this stuff. But what we wanted to try to do was tease you a little bit with these little handout pieces. And as you go through it, you look at starting the long-term care conversation with your clients. You know, you look at it. Have you ever had a family member, a close friend, you know, who required long-term care? You know, what's the impact to the family, both emotionally and financially? That's the reason why I asked that question, could you change your mother or your father's diaper? I don't know if you've ever had to do anything like that, but I've had to help people. And I know Kyle has in this meeting here. He's had to help people. And, you know, you can see it in their eyes that they're embarrassed that you had to go help them to the restroom or to do that stuff. And I say that with the most humble thoughts, because we really have to look after these people. You know, my mom and dad, you know, they changed my diapers when I was little. They looked after me when I was little. And so the thing is that I hope that I'm at the point where I can do that. The thing that's neat about these benefits is you want to make sure that those benefits will actually pay to the person, and it might not have to be a facility. And a perfect example on that is that if we bought a policy and it had that benefit and that $2,000, and let's say that I was making $25,000 a year working and my husband was making money, so I want to go stay home with my mother or my father and help them, but there's no way I can do it because we need our money to pay our bills. Well, now here's a way that we could actually accomplish both goals. We could pay for our family, you know, needs, immediate needs for us personally, and then I could help look after my family. And, you know, one of the biggest growing segments in America is children moving back in with their parents. I mean, when you look at the unemployment rate when it was as high as it was, this is statistics that we actually saw. And, you know, one of the statistics I wanted to share with y'all today is that yesterday I met with one of the LIMRA officials, and I don't usually hand these out, but I wanted to show y'all just a couple of things just to tell you what's happening on the first quarter of 2014 in the United States. When you looked at the life insurance on the second page, the individual life insurance fell for the second consecutive quarter, making it the first back-to-back quarter decline in life insurance sales since 2009. The annual premium dropped 7% to begin 2014 compared with the first quarter of last year. And if you look at these declines, it's because of the sales in lifetime guaranteed universal life. After 51% drop in long-term guarantees in the first quarter of 2013, sales of those same products fell 48% this quarter. So what does that tell us? That tells us that the people are going back to current assumption products. They're got to figure out some way that they can make cash inside their products. Now, you listening to this material in a better position than most people, because a lot of people don't even know this is existing, because we have been sold by these insurance companies. Oh man, you got to have the guarantees. You got to make sure this thing's guaranteed to a certain length of time. When you look at an average 65 person, and you know what a bell curve looks like, it looks like a U, an upside down U. Well, when you look at 50 percentile of the marketplace, that life expectancy is 83. You know, over 90% of them have died by the time they're 95. Well, see, a lot of these products, you can pick 95, you can pick 100, you can pick different ages. So when we look at these trends starting to happen, we need to make sure that we're on the other side of this curve. If you'll look at the third illustration here, it talks about Universal Life has the highest portion of the premium sales for the past decade. It had a 1% point drop and 37% of the market through the lifetime 3 months of this year. IUL represented 48% of all the UL premium. Now, when we look at down here, non-IUL lifetime guarantee in the market share was 21% was non-IUL, 2% was IUL, so a total of 23%. When you look at current assumption, it's up 31%. When you look up the non-IUL and the IUL for accumulation function, it's up 32%. So the thing that's happening is that if you're out here selling today and you're not selling the index UL product, if you'll add those columns up, that's 48% of the market, right? So you're missing out on 48% of the sales. So if you're going in and seeing clients and you're not making as many life sales, it may be because you're not showing that product to people and they're buying from somebody else. They just ain't telling you. Now, some people still are not going to buy. But see, when you look at the VUL marketplace and you look at the whole life marketplace, it's starting to look at the growth. Now look at the sales growth by distribution group in the first quarter of this year. On Universal Life, the affiliated people, your State Farms and your Northwestern Mutuals, the affiliated companies were down 14% of their production on UL. When you look at the independents, it was down 16%. While on VUL sales, the current was 15% and the independent was 25%. If you look, there was a growth on the term was down 4% and it was a negative 2% on the independent channel. When you look at the total for the whole life, it was down 6%. So when you look at the growth so far this year, we're down negative 6% on the affiliated people, and we're down 9% for the agents. So when we look at the first quarter of annualized premium growth from the brokerage standpoint, we're down 5%. When you look at the PPGAs from last year to this year, and this is from Limmer Gang, this is not from Terry coming up with this. I got this from them yesterday. And so when we look at it, the PPGA market distribution, which is what we work in, our production for the first quarter was down 30%. The wirehouses down 20%. If you look at the individual agency builders, the career builder guys, their production was down 6%. Now, why would you think theirs was not down as much as the PPGA distribution and the brokerage distribution? The main reason that I think, this is a personal feeling, is because we're working together. If you're in an agency building situation, we're focused on having appointments. You got somebody helping you. You got a manager. You got somebody holding you accountable. And so those people are going to push harder to do more business. When we're an independent brokerage person, we might be a property and casualty agency. We might be a health agency. So we're still making enough money on this, so we haven't focused a lot. When we look at the first quarter of January, February, and March, one of the other things that we looked at was the Affordable Care Act. How many of our agents that are out here work the health market hard for that 90-day period? Any of them that sold health insurance had to, because March the 31st, unless they had a qualifying event, what happened?
They couldn't sell it anymore.
On April the 1st, they were unemployed. So see, we're living in a different world. When we look at the home service market, it was down 1%. That's not much of an effect. And that's the debit companies. But see, they're not doing most of the business. And when we look at the work site management, it was down 10%. The direct writers on the television, you see them selling, they were down a negative 2%. And we look at the banks, they were down 2%. So when we look at all the things that we're trying to do, we've got to look at, what type of policy we're selling, what type of insurance we're doing. And when we look at the first quarter, I thought it was interesting to see that the average UL that was sold was $254,104. The average target premium was $4,124. And that equated to about a 16.23% universal life cost per thousand. When you look at the VUL was 17.61 cost per thousand. The average premium was $492,556. So we're looking at $8,676. We look at the term market. The average policy was $397,891. The average premium to all the companies that reported to LIMRA was $910. When we look at the whole life, the premium was $1,140. So it's very easy to see when we look at the average of what we want to make as our income. If the average, and we're out producing universal life, and the average premium is $4,000, and we're making 50%, we need to do, if we want to make $8,000, we got to sell $16,000 of premium. In the LIMRA statistics, they say 90% of the agents out there in the brokerage market make less than $50,000 a year. So how many appointments are these people having? How many people are helping them to get to where they want to be? When you look at the last to die market, this is really scary to me, because this is the high-end estate planning market where we actually go out and we try to sell clients on how to look at passing their estate on from one person to multiple people or to family members, or pass on a business or entities or a family limited partnership to the next generation. If you look at the Survivor UL from an annualized premium standpoint from LIMRA, it was down 51% the first quarter. If we look at the face amount, it was down 53%. If we look at the policies issued, it was down 44%. When we look at the Survivor Variable UL, it was up 13%. The face amount was up 7%, and the policies issued was up 33%. When we look at the Survivor Whole Life, that premium was down 17%, the face amount was down 20%, and the policy issues were down 20%. So when we look at the overall market on survivorship, based on policies issued, it was down 36%, or 1 out of 3, and the annualized premium was down 42%. Now, one of the things that we might think about, why would that annualized premium be going down? Why would the face amounts be going up on the variable sales? Why would variable sales being positive and the negative on the annualized premium on the brokerage side and the regular, all the SULs was down 51%?
It's because the variables come with guaranteed riders?
No, the reason, that's a good answer, but the main reason is because on the variable, on the Survivor ULs, they don't build much cash. It's a death benefit sale. So it tells you that people are leaning more to having a product that is cash assumption. And so the thing is that you as an agent, are we ready for those type of sales? If you're just selling order takers, somebody to cover their term insurance and things like that, they couldn't do it. On the last page, it talks about premium and product definition. It talks about affiliated. That's an agent under a contract with one company. And this is all the their information. So what I wanted you to see is that as we go forward and looking at what we're doing, we want to try to look and see what marketplace that we want to work in. And then we want to see, at least if we're selling against these type of products, why are we not showing these products to our clients? Kyle and I worked on a case just recently that it was a lawyer in Washington, D.C., and this lawyer had $409,000 in a guaranteed UL contract with a A-plus company, but it wasn't building any cash. And those of you that know what a spousal access trust is, I will give you a copy of that. Minnesota Life has a great brochure on it. And so it shows people that even though you might have a trust set up and the beneficiary of that trust may be your wife that draws income or your children or whatever, excuse me, now if you need money for maintenance or need some help, you can pull money out of these policies. But what happens when you bought one of these guaranteed UL policies that have no cash value? You put all your money into a product that builds no cash. It's guaranteed to age 100, but you have nothing to pull from. And so this client actually rolled $406,000, took up a paid-up policy, took his $400,000, went not with a guaranteed UL, he went with a current assumption UL that just guaranteed and had an interest rate tied to an index. So at least in his mind, he thought that this thing would work. When we look at our index products, each one of us here and listening on this webinar, they all need to say to themselves, you know, how am I going to get to age 65? How am I going to pass my estate on to my kids the most efficient way? How am I going to get the retirement income that I need, plus leave enough to take care of my spouse if I was to predecease her and not be able to tell her what we're going to do? All of us, I don't know what our dream is. You know, I reckon, you know, we live to be 100 and we look in our wives' eyes and we die and go to heaven at the same time. You know what I'm saying? You know, that's a good dream, but, you know, a lot of us don't have that benefit. You know, if you would have asked me, I would have told you my dad had cancer and he had a lot of issues, kidney stones, all these things that, you know, you'd have thought he'd have died first. And my mother died 6 years ago, and now my dad's 82 by himself. He's not equipped to be by himself. That's just not his makeup. My mama did everything for him. And if he was sitting here today, I'd say it in front of him. But see, what ends up happening is now when we look at the interest-sensitive market, if somebody would have told me when I started my career 35 years ago that the interest rates would have been 3% or 4% on a 15 or 30-year mortgage, I'd have told you you're crazy. Because in 1979, my first interest rate on my house was 12%, and I only got a 3-year lock-in. At the end of the 3 years, we had that. Those were the Jimmy Carter days, and if you remember, we had CDs out there paying a lot of money. And when you look at the interest rate on the insurance companies that we've sold current assumptions products up until index products, can y'all tell me one company in the last 30 years that have went up on their interest rates on their life insurance? It hasn't happened. And see, nobody talks about that. You still getting that? And see, if we bought a policy 10 years ago, I don't mean it bad, but see, what is the reasoning for a company to go back and adjust those old policies?
No reason.
And see, so the problem that we have is adverse selection on a lot of these old company policies are still in force. Everybody understand what adverse selection is? You know, see, think about it. When the people that are healthy can leave and they go buy somewhere else because they can get a better rate. And see, think about me. Last year, I had a policy for, gosh knows, 20-something years. I switched one of my life insurance policies to $600,000 of it to an index product with the long-term care benefit. Because in my mind, even though I had to pay a little bit more money, it was worth it to me. Because when we ran an illustration buying a Genworth or a long-term care policy to give me a $350,000 benefit, I had to pay approximately $5,800 a year at 57 until I die. So I'm going to pay, say, $6,000, and if I live 20 years, I'm going to pay $120,000 for a $350,000 benefit that I may never use. If I take that same $6,000 and put it into this Minnesota Life product we're talking about today, I'm building cash value. I got my policy. And see, being in an independent distribution system, not only can we sell Minnesota Life, we can sell all the top 10 companies that sell index. And we market all those through our umbrella. And the reason why we have them, I always ask myself, why add another company? Well, see, for an example, some companies have a higher retention. If you look at Prudential, we're an IMO with Prudential also, where Prudential has a $50 million binding limit where they don't have to go out or research it. So if they go out and look at it, I don't know about y'all, but I don't sell many $50 million policies. But when I do sell a bigger policy, if I sold, like one we just did was $30 million, $35 million, and the man had $35 million in force, so we had to get a letter saying he was going to cancel that so it wouldn't go over the jumbo limits. And so we got that policy issued and got it placed. And see, so as we start looking at the market and we start looking at the long-term care, this one little folder here entitled, the confidential analysis, this is a neat little piece. And as you start doing fact-finding and planning, it actually makes it harder for me and you to figure this out, because when we look at it, we want to have a place in a file that every time we go out and see a client, we want to have a new business file that we have different things in there, so that we don't get caught up in, oh gosh, I got to run by and see this person, and I was supposed to be here at the office at 8, and I got sidetracked and I didn't hear at 8:30. They're going to be here at 9. Lord, let me just get ready. And so we're not prepared. And see, I look at the thing that I tell people about working with your clients and agents. I tell my clients, everyone, I'll tell y'all this, and y'all are friends. When we look at building our relationships, there's things in life we can't pick. We can't pick our parents, and we can't pick our children. So the thing is, two of the most important people in your life is your family, your mom and your dad, and your kids. And you can't pick those. So the only other thing that we can pick is who? Our friends, our traveling companions. And so I look at my clients as traveling companions. I start understanding who they are. I start understanding what their needs are. I start understanding, how this kid plays softball. This one's a ballerina. This one does this. And then some of them do have some health issues. Some of them have things that happen in their family. And see, that's what makes sort of a life worth living, in my opinion, because, you either have a servient attitude to help people or you don't have a servient attitude. If you have that attitude and you help people, see, we can do it in all facets of life. We need all the people in our life. I need the garbage man at my house because I chose not to do that for my career. So I'm happy for that guy. And when I see him, I'm nice to him. I tell him, thank you. I appreciate you coming by picking this up, because at least he'll do it. The painter, the plumber, the worst guy is the guy that cleans my sewage tank out, right? Nobody wants that job. But the thing is, thankful that there's somebody that will actually do that job. And see, when we look at the agents in North Carolina, there's over 40,000 licensed agents. If we look at it, there's 8 million people in America, right? Not in America, 8 million in North Carolina. Somewhere around that number, 350 million in America. So if we look at it, and if our math is right, and if there's 40,000 licensed agents, and there's 8 million people, is that one for every 2,000 people? That's 40,000? That's one for every 2,000 people. So the thing that we look at, man, if I could just sell 100 people a year, I'm going to be happy. You see what I'm getting at? So when I look at that spectrum, there's some people selling cars, homeowner insurance, some people selling life, some people selling disability, some people selling annuities, some people selling med subs, some people selling health insurance, somebody's selling group insurance, some people doing accidents, somebody's doing cancer, somebody's doing different types of benefits. But as we look at these impairments, how many people look at it? In 2011, there was 5.4 million people in America living with Alzheimer's disease. And 2/3 of those were women. Now, when you look at these statistics, these things can disturb the client. Because, see, people don't buy insurance unless you can do one of 5 things. No need, no hurry, no worry, no money, and no confidence. No need, no hurry, no worry, no money, and no confidence. Every one of those things. No need, no hurry, no worry, no money, no confidence. Now, the no confidence, That's very important, because up front, when we're starting to work with our clients on these things, we've got to get that confidence level that they know that we're what? We know what we're talking about. And see, it's easier on the long-term care type sale, because if you look at North Carolina, they say less than 10% of the agents have a long-term care license. So let's say that's 4,000 people, and I bet you it's lower than that. I don't think it's much more than 2,500 people. I don't know that for a fact, so don't quote me. But when you look at it, it's a small number. And so when we look over here, they predict most people survive an average of 4 to 8 years after Alzheimer's diagnosis. Some live as long as 20 years. By 2050, they predict there'll be 16 million people with Alzheimer's disease. And who's going to be looking after these people? See, if I don't have a policy on my dad, who's going to have to look after him? Either me or my brother or my sister. And see, I've got 2 friends in Lumberton, North Carolina, that what they do, they have 5 children. So every 5th week, guess what you got? You got mama. True story. And so what happens is that on Sunday afternoon, they trade off and they go with mama. But guess where they stay at? They don't bring mama home because they don't want to disrupt their family. So what does that family member do? Go to mama's house and stay there 24/7 for 7 days. Now, some people can't do that. You know, I don't know what your boss would tell you if you told him you were going to go every 5th week. You were going to be gone for 5 working days. Well, see, those 5 working days really turn into 9. Or not 9, Sunday and to Sunday, so 7 days. You know what I'm saying? And, you know, and when I talk to them, you know, they say it's really work. I'm not saying it bad, but it really is work. When we look at, and everyone's going to have these little brochures. I can't read them to you, but you'll have them in print for you. When we look at the home office carriers, you know, one of the things I challenge each one of you to do is that every Thursday we have a new idea, a new sales contact, you know, from 9 to 11 o'clock, you know, sometimes 9 to 10:30, showing you different sales ideas and bringing you to what the marketplace is. Because knowledge builds confidence. And see, that's why I want to know what's happening out there in the marketplace. That's why I was excited to share this LIMRA detail with you. Give me one break here. I'm trying to open this PDF.
So it's loaded.
I'm actually a fast clicker. I don't like, you know, not being able to click this thing through. But see, as we look at long-term care, the caregivers that are out there, you know, then the other thing that we got to really consider is that how are we going to pay for this care? You know, how are we going to go out? You know, there's 3 different ways we can look at it when we pay for it. We can rely on the government. We can self-insure, or we can transfer the risk. And see, these are things that you need to incorporate in your sales talk. These are things that you need to incorporate when you're talking to an individual. Because see, when they look at it, they say, you know, I specialize in long-term care. You know, and I always ask people the same question. You know, how are you going to take care of this at some point? And so there's only really 3 answers. Rely on the government. And how many people are relying on the government today? We have over 50 million drawing welfare and food stamps. Now, when we look at that don't sound like it's too bad. But when we look at 350 million people in America, if half of those are family, we're down to 175 million. And if each person averaged 1 kid, now we just cut that 175 into what? Half of that? We're 80, let's say 80 million. And then we got 50 million drawing subsidies. So we're building a country that is expecting who to take care of it? We're expecting the government to take care of it. And see, what happens is that when we go out today and look at it, you know, if we rely on the government, we got Medicare, we got Medicaid, and I used to talk a lot about it. Now I get a lot of pushback. I talk about veterans benefits. And see, that's in the news today. I really don't think it's as bad as we want to make like it. You know what I'm saying? There may be some things that are just not done right. But, I still think that the veterans program is a good program because I've seen people and I've been to the hospital and I've never experienced any of some of the things that I see. I know that there's some challenges. But see, it's just like in America today, we're reading about 35,000 plus kids tried to cross the border this past month. And, they got them in Texas. And now the news just showed yesterday that they got a lot of contagious diseases. They've got them in a place where they're trying to contain them and things like that. Well, see, some of the countries that you will go to, I've been to Africa and China and been on mission trips. They don't have the same care we do. When I went to Africa, I had to take a polio shot. Now, who would have ever thought you'd have to take a polio shot? But they said, you're over 50 and we're scared that the polio vaccine you got when you were young is not going to help. So I wasn't real happy about taking a polio shot at 55 years old. But I wasn't happy about thinking, man, I'm going to go in the orphanage where 150 kids are at and work with them for 14 days. Go into churches where they have 400 members plus their kids. There's no telling what you would get. So I had to take malaria, yellow fever, diphtheria, all three of the hepatitis shots. So when we start looking at those things, we've got to decide, hey, look, is this a benefit that I would like to have when we talk about that long-term care piece? And so when we look at long-term care, we got to understand the differences between a typical long-term care policy and the long-term care benefits inside that. And see, what most of the time it narrows down to is the activities of the daily living. Activities include eating, bathing, toileting, continence, dressings, and transferring, and several cognitive impairments, loss of intellectual capacity, which you need supervision by another person, the number of days the insured receives service before benefits become payable. And see, what a lot of people end up doing when they go into these facilities, they have steps. Like one of the guys that worked here, his mother went into one over on Blue Ridge Road, and the first step was just taking care of her. She was doing fine for about 2 or 3 years. And then one day we were sitting in the office and we got a phone call that says, hey, your mother's next door in the lady's room putting on her clothes. And she's arguing with that woman saying that this is her room and these are her clothes. Now, so he jumped in the car and he said, would you ride with me? And I said, yeah, I'll be happy to. So I rode with him and he got there and he broke down because that was his mama. And it was very touching, it's sort of hard to explain that to somebody sitting here in a little meeting. And I just had to hug him and say, hey, look, man, that's your mother, but that ain't the mother that you grew up with all these years. She's got this one little ailment, and you just got to have to breathe and get through it. So then I said, look, just let's get her clothes on. And we asked the lady, say, is it all right if we just give you your clothes back in a few minutes? She said, yes, y'all just go deal with what you want to. I'm fine, because I know her because she was my neighbor. You know what I'm saying? So they love each other, too, to just at a different stage. And so what ended up happening is they said, well, now we got to move her to the next level, which means that, when she goes to bed at night, guess what we got to do? Strap her in. Put a little alarm bracelet on her so she can't get out and all that stuff. Well, what that means in English is that it's going to cost a little bit more money to do that part. You're in this part, it costs this. When you go to this part, it costs this. Bill Adams, one of my best friends in the world, he's in his 70s now. His daddy is 96. He actually thought that, when his dad retired and everything, that his dad was an insurance agent and he had amassed a good fortune, in his career. But then what happened was when he got to his 70s and he couldn't look after him, he went into one of these assisted livings. And they got a deal. If you'll pay a certain amount of money per month, if your money runs out, guess what they'll do? You can stay there till you die. Did you know that? And so what happened to him, he'd have thought something would happen to his daddy a long time ago. His daddy's 96 and still going. Now, he wasn't concerned about that from the time for the money standpoint, but his mama died last year, so now his daddy's, having some issues. and he's having a little bit of dementia and things like that, which is the first stages of Alzheimer's, if we want to call it that. And so now his concern is, how do I go and help my dad, make him comfortable and those things. And see, so all of a sudden, he spent his whole life amassing his money. At retirement, he started using his money to buy back his health. You know, I always use it. I say we trade our health for our wealth. And then when we get older, we trade our wealth to get back our health. Because that's why we've got so much medications and why we're taking so many drugs and things like that. So when we look at these ADLs, make sure that we keep up with it. Because most of our policies have a 30 to 90 day elimination period. You know, we just need to know those type of things. So that when we go out and look at this, we actually feel comfortable in telling the clients that we're working with how this works. And then, one thing that I always look at is that I've got a little spreadsheet that it's hard for me to show y'all that are listening via the internet. But we've got a long-term care comparison, and it's right here in the back here. And I just want to hit this little chart so you actually know how to read it. And it just tells people, you know, from an individual long-term care, a base combo with accelerated death benefit rider, chronic illness with accelerated benefit rider, acceleration death benefit with extension of the long-term care benefit, and then just a long-term care rider combo that's tied to an annuity. I'm not saying that any of them are bad. I'm not saying that any of them are the best. You know, when people ask me what the best life insurance is, I tell them when you got enforced when you die. Because I've never delivered a death claim where a person said, now what was the name of that company? You know, they don't care. They just want to see the check. When my family member goes in and we got a long-term care benefit, I want to know what the amount is. I do want to have a good company, so I'm being funny when I say that. But see, that's why we like to write with these A-plus excellent rated companies. You know, today our talk has been on Minnesota Life. If you look in the Comdex rating, they're in the 93 percentile. They have better ratings than 93% of the companies that are out there today. That don't mean they're a better company. That just means that their financial stability is secure. There's only roughly 14 companies that have the same rating or better ratings. Now, the thing that you look at, 95% of the companies are A or A plus rated that do all the business with, AM Best. You know, so a lot of people use AM Best to look at their ratings. Some people use the Comdex rating where they take all four of them and bring those in. And see, when you look at the companies and the products, you got to look at the definition. You got to look at the benefit amount. We got to look at the underwriting when they get to that point, and the underwriting classes that are available, and then the premiums, and then we got to look at the charges and how they can raise those premiums. Some of the policies will not raise the premium unless what? They raise it on every single person. And see, sometimes those are done by different states. We're licensed in all 50 states, so each person that's listening to this needs to be aware of what your state does approve and what they disapprove. Like, for example, on a final expense policy, some states like North Carolina, there are very few what they call modified benefits that are allowed to be sold in this state. There's only a handful. You know, some states don't care about that. The other thing is that impact on the death benefit. If you have an individual long-term care policy, there's no impact on the death benefit. If you've got one with accelerated death benefit, it's a dollar for dollar reduction in the death benefit, you know, and the residual death benefit, you know, typically is whatever it is. And, you know, most of the companies force you to keep at least $25,000 death benefit. So if you had a $1 million benefit, they would subtract $25,000 from it. They would figure your long-term care benefit as a percentage of what's left over. And why is that important? The reason why that's important is so that you don't die later on down the road and have phantom income. Everybody understand phantom income? For example, if you put in $50,000 in a policy and you pulled out $100,000, you had a gain of $50,000. If you die, remember under Section 101 of the Internal Revenue Code, which says it's a life insurance policy, if a life insurance policy pays the death proceeds, you don't have to pay anything. You just got your death benefit. But let's say that you went out and you pulled out the $50,000 more than what you put in and you lapsed the policy, you're going to have to pay for that gain. Now, it might not be full income tax because I'm not a CPA, so let me just go ahead and say that. You know, I don't know what the rate's going to be because I'm not a CPA. But I do know this. I do know if you put $50,000 in a tax-sheltered investment like a life insurance policy, if you pull more than that out of it and then surrender that benefit, it's going to create a 1099-R or some kind of device that goes to the government that's going to force us to take into account of what that is. See, when we borrow money from this policy, it comes from the death benefit. And the IRS dictates how we can pull those monies out. The IRS don't have any problem today, I don't know what tomorrow will be, but they don't have any problem today when it's a chronic illness and they say you got less than 2 years to live. They say that's just as good, so when you pull that death benefit out, none of that death benefit is taxable. Now, does anybody know what the maximum rate today is you can pull out for a long-term care benefit and not trigger tax with the IRS?
$300.
It's $900. It's $300 a day. Yes, $300 a day. So $9,000 a month. So if you bought a $10 million policy, the reason why I'm bringing this up because I just want to make sure that you understand it. If you got a $10 million policy, you can't go out and pull 4% out of a $10 million policy, pull out $400,000 a year, divide that by 12, and pay your family $30,000. Look at the father or your mother. You can pull out $9,000 and it's not going to trickle anything there. Like I said, I don't want to get into tax today because I don't have enough time to do that. I don't have no tax people here. But the thing is that there is a limit of what we can actually pull out. And so when we look at inflation and other options, you know, does it increase? And see some of these riders that are out there with the long-term care like benefit, and let me go ahead and say this right now. Those of you that are selling that benefit, do not call this a long-term care policy with your life insurance. You're going to get in trouble, especially in North Carolina if you don't have a license. Because, see, then what you're admitting to is that you're selling a product that you don't have a license for. Because in North Carolina, you have to have a long-term care license. This is a long-term care type benefit. And here's how it works. So you explain what that benefit is. And so the reason that I like this is that I can cover all my bases. Because most of the clients that I deal with are average people. They go to work, they got bills to pay, they're looking at transferring some of that risk, right? They're not looking for the government to take care of them. They really can't set up a sinking fund because, you know, I make a joke about it, and it's not really a joke, but, you know, it's sort of humorous because every time I talk to somebody about it, they laugh at me. And I say, well, look, do you have a 6-month reserve of your income so if you had something catastrophic, you could take care of yourself until you find another job? I would say 90% of people I talk to say no. And I say, okay, do you have any kind of emergency fund to buy tires and buy a battery for your car and all that other stuff? Most of the time I get that as a no. I met with the police chief of a place, I won't tell you who it is or what town it was, but we were looking at the difference between what he needed to do to take care of himself. He was 53 years of age. He's got 12 more years before he's going to retire. And he needed to either spend $95 or $135 based on what he needed to buy. And he said, well, you're going to have to figure it on $75 because that's the most I can pay out of my check right now. I said, you can't find $20 more. He said, no, sir. And I said, okay, I respect that. I said, but can we start working on trying to do some of these things? I said, because, see, you've already told me what you owe in your house and what you owe here. And you told me your wife didn't work and make but eggs. So we know if something happens when I leave this office today, if I leave here today and something happens to you, you know that there's going to be a shortfall. But me and you will never be able to talk about it again because you'd be gone. And so I just want to make sure that when we talk to your wife that we are all in the same agreement. And see, that's one of the things when I bring in with people on this long-term care, one of the things that I have is a form that I get them to sign after I talk to them about it. And this form is a very simple form. I got it from $1 Million Roundtable. And what it says is, it says that, you know, we have reviewed long-term care benefits as part of my financial plan, but at this time I've decided that I do not want to participate and to buy that. Now, the reason why I do that, especially on people that are in their 60s and stuff, because when their kids come to me at the nursing home or whatever, I can say, hey, look, I spoke to your parents about this, but they didn't want to deal with it. They said they would just pay cash. Now, I have some clients that have over $3 or $4 million in their retirement plan. So can they afford to go stay anywhere they want to in a long-term care facility? Sure they can. Okay, am I going to argue with them? No. But the thing is that when I tell them, I say, you got two choices. You can pay for it out of your cash, or you can have this type of life insurance that has that long-term care benefit. And so now the thriftiness comes out of that person, because the person that saved $3 million, they're thrifty. Because when we look at it, would y'all care to guess in America today what the average amount of money in a retirement plan is?
$25,000.
A little over $20,000. That's exactly right. And see, so what happens is that what is our plan then? If we look at it, we're going to have a sinking fund to put it there, or we were going to rely on who? The government, or we were going to try to do what? Transfer the risk. Remember, we're going to transfer the risk to somebody else. Well, see, when we get to retirement age, how do we transfer the risk to somebody else? Y'all know the answer. What are they called? KIDES. It's called kids. Because when you get to that point, what choice do you have? How many of you today, don't raise your hand, but how many of you today have had to take care of your wife or your husband's family, as some member at some point? Every one of us is going to have to do it. There's no way you cannot do it unless you're an orphan. You never knew who your parents were. But then it's going to be on somebody else. And see, so when we look at these benefits, for the long-term care piece, we have to actually look at it coming back, from the analysis of how am I going to do this. The last thing I want to go back to is when we started off was the financial calculator. That's on the last page. And it just has a place where we put all of our questions, about 13 or 14 pages. Now, don't pull this out in front of a client and start filling it out. You'll scare them to death. Because when they see you pull out 14 pages and you just met them, they're going to go, oh my God, I ain't going to tell them all this information. That's why I use a legal pad. So memorize 8 or 10 important questions. What would one of the important questions be? What is your plan down the road if you do come up with a long-term care? How are you going to pay for it? Do you have a will? Do you have a sinking fund? Have you set up any money? In case something happened to you, remember, unsure future. In case something happened to you, how are you going to pay for these benefits? When I built this building here, the first thing I did is I went and bought a 15-year term policy for enough insurance to pay the building off if something happened to me. Now, why would I do that? Because if I didn't, where would that burden go if something happened to me? My wife or whoever would have to take that burden on and go pay that. Now, how is she going to go to a bank or some lending institute and say, hey, look, I know Terry's gone and y'all know he was a good guy, but I need to get y'all to loan me a couple $100,000, so I can get this building in shape and do this stuff. They don't know her. They might not know my business partner if I had a business partner in this venture. So see, now we start looking at it. See, when we go on the interview and speak to the husband and the wife, that's why I like both of them to be at the interview. And if they tell me only one of them is going to be there, 9 times out of 10, I'll reschedule. I've heard these famous words, and they'll say, look, I don't need my wife to make a decision. I said, yeah, who are you telling that to? Dude, let's get her on the phone and call her real quick and see what she says about that. Because every person's ever said that to me, when I get through, guess what they always say to me? Oh, man, this is good information. I need to talk to my wife about this. And see, I want the input. Because see, when I look at the wife or the husband, I ask them both this one question. And we'll wrap up after this. What keeps you up at night? What do you think about? You know what I'm saying? I look at the wife and I'll say, if you look at everything looks like it's going pretty good. You shared some information with me. And one of the guys yesterday said, I never looked at this analogy, but this guy owned a bunch of Bojangles. I won't tell you how many because you can guess who he was. But he owned a bunch of Bojangles. In excess of 40, I'll say that. And me and him were having this conversation. And he says, well, I got plenty of money. I don't need a whole lot of life insurance. And I said, but when is the last time you went and looked and had you and your wife to sit down and say, hey, look, you don't own that franchise. Who else owns it? Somebody else owns the franchise. So you work for them and you own the building and the plant and all the other stuff. So how do you propose to get this to that person? I work with a lot of car dealers, same thing. How many car dealers have got a girl or two girls and one boy, and they want the boy to run the thing, and what they're going to do with the girls? Has anybody ever heard of equalization? Where you got to equalize, the benefit. My mama was that way. When my mama died, she gave every grandchild the same thing, 10 of them, the same dollar amount. Now, when she gave me and my brother the amount of money, did she give us the same amount? Yes. When she gave my sister, she gave her a lot more because my sister's disabled. But she asked me up front, and I said, hey, look, I can take care of myself, Mom. You don't have to leave me nothing. You give it to my sister to help her, because she was in a car accident when she was a senior in college, and she's been disabled ever since. So she's going to have special needs. So I want to know that about people. Do you have special needs? And you don't have to be 65 to have special needs. My sister's 50 years old. So does she need something? Yes, I need this. She'll be 50 next year. She'll be mad if I told you she was 50. She's only 47. So when we look at what happens is that, how do I equalize that? Well, see, it's real simple. I told the man yesterday, I said, look, if your estate was worth $9 million and you had two girls and one of the boys was going to run the business, you had to give the kid $6 million. You got two choices. You really got three choices. You really have four choices. The first choice is write a check for $6 million. The second choice, which I don't like, is go to the bank and borrow $6 million. So let's say you're a good businessman and you're smart. You go to the bank, borrow $6 million, and they charge you 5%. 5% times $6 million is $30,000 a year. 30,000, right? 300,000. It's 300,000. So that's $25,000 a month. In 20 years, you've paid how much? $6 million. How much do you still owe? $6 million. So you saddled your child with a debt of $300,000 for the next 20 years, plus you saddled them with a $6 million debt because you wanted to give that piece of property there. Now, what would have been an easier way? For about 2% of that $6 million, or about $120,000 a year, guess what you could have bought? You could have bought a $6 million life insurance policy that you could have made the owner of the company. The company could have turned around and set it up in a trust the right way, and then use that money to buy the stock from the company and give it to the son, and the son turn around and take that money and pay who back? The two daughters. Now, guess what he owns free and clear? He owns all the franchises. He owns everything free and clear. So that just gives you an idea on how we can do what? Leverage it. Now, the third option that we can do is set up a sinking fund. So if I'm 40 years old and I figure I'm going to live to be 70, that's 30 years. So if my taxes if I got to pay my kids $6 million, I could just pay them $300,000 a year for the next 20 years, right? Put it in the account. And at the end of the 20 years, I'd have $6 million. So I could just give them that. Now that's tough too, isn't it? Because now, how do we pay that $300,000? Where we got to get it from? We got to get it from our cash, from the company, right? Okay, now anybody care to figure out, is that net of taxes? No. So if we pulled out $300,000 out of a company, would that probably put us in a 50% bracket, counting state, federal, FICA, and everything else? Close to it, wouldn't it? So for illustrative purposes, let's say it's 50%. So now to pay ourselves $300,000, we got to pay ourselves $600,000. So now you're going to strap the company with $50,000 of debt to set up a sinking fund. Do you pay that to do that? And then a fourth option we could have done was buy a life insurance policy at that 2%. So to reiterate, the first option, pay cash. Just write a check for $6 million. Second option, borrow the money, pay interest on them. Third option, set up a sinking fund, save it. And the fourth option, which is the best option, to buy life insurance. And so we've got all the marketing material to give you with this here sitting here looking at it. So you could actually go out and go buy that. When you look at the definitions, I challenge you to look at an individual policy. You have a chronic illness definition, 2 out of 6 ADLs, and you have a severe cognitive impairment. If you look at every policy that we sell, we have the same definition as that long-term care policy. It is not a long-term care policy. It is a rider on a life insurance policy that gives a percentage of the death benefit. And it is not a free benefit, because what it's going to do is that as we pay that benefit out, guess what it comes off of? The final death benefit. You know what I'm saying? And so when we start looking and pulling all this information and helping ourselves to do this, all we've got to control is what these companies tell us what these benefits are. That's why I say to go review these and see, when we look at it, how many of them really charge for underwriting. And see, sometimes some companies have knockout questions. Some companies, have a higher mortality charge if you have some issues. Most of the carriers that we write don't even underwrite that benefit. Now, the only thing that's scary about that, I will say this, is that we really don't know what the exposure is from these companies and these carriers. When long-term care was first started, I was one of the first agents to sell that. The concern that we all had is that nobody had ever used that type of product. So we didn't really know, what to expect from the claims and stuff. And see, so we're sort of feeling our way in the dark with the Genworths and with the Minnesota Life, with the John Hancock. And see, I can tell you that there's a disparity of the premium. And so, some people will buy a Cadillac plan, some people won't. We have a couple companies that have a 10-pay that's a guaranteed. So you pay the premium for 10 years, premium's guaranteed, it's paid up for the rest of your life. You never have to pay any more premiums. Now, what happens? Most people won't afford to do that. And see, the very hardest part of our job as professionals is when we go out and talk to a client and they only have $200 of discretionary income in a month, and to figure out what we're going to sell them. The guy that's selling an accident policy with a company, what's he trying to sell? Accident. So when we look at that piece of pie, that's why it's important up front to cover those 5 things. No need, no hurry, no worry, no money, and no confidence. If we can show them we have the confidence and we have the products, and we can show them that there's a need, and we can build a sense of urgency, and if we can concern them. You know what I'm saying? People will do something that are concerned. If they're not concerned, they're not going to do anything. It was just like the gentleman that I had yesterday. He stayed with me 3 hours yesterday on that interview. And so it all started on talking about long-term care for his family members. And it was really his father and his mother. They're in their 80s and 79 and 80. Well, when we start looking at planning today, anybody care to guess what $1 million benefit would cost on somebody that way? It's in excess of $25,000 if we can find somebody to write it. The hard part is getting somebody to write the thing. And so our planning is sort of tough that way. So then now, when a person looks at the average stay might be $40,000 according to who you talk to a year, $3,000 a month, some 4 years. So your ratio might be 40,000 times 4 years. It might cost you $150,000 for your parents to go into a facility. Well, if the premium is $25,000 a year for 2 of them, they may say, well, crap, we're going to pay you $100 in the next 4 years, whether they go or not. I'm just going to self-insure it. Kevin was looking at a case the other day where we were dealing with somebody in their 60s that had $108,000 and they were going to pay another $600 to get $1 million. So they were only going to get another $350. He said, well, maybe I would just pay the cash in there and not do that, because if I don't die in 11 years, they were going to lose their insurance. That's a bad way to plan. Any questions?